Right. Here are the building blocks. This is an R3 level on a chart. R3 is resistance level number 3 on your standard pivot points. This is an indicator freely available to you on MetaTrader, freely available to you on most major charting platforms. You don't need me to get that indicator. A pivot point. If you don't know what a pivot point is, just look it up. S3 is support level number 3. That's the extreme level when using pivots. You could say that that's like the bottom band in the Bollinger Bands. R3 is where we're going to start. Here's a today's Vortex Trade number 1, first example. This is the pound Swiss, it's my favorite currency pair. And on this particular day, the pound Swiss rose up and touched R3. You see it right there. It touched R3. For me, this means that something exceptional has happened in the market. Something extraordinary has occurred in the market. Some major event, some panic-driven experience, a news report, economic, bank failure, or just an ordinary day where people really went nuts in the currency markets. And automatically, I'm thinking of trading this currency pair back down towards that daily pivot. Now, a lot of people are thinking about trading it up, right? That's a trend. The trend is your friend, whatever. Right? Whatever. Fine. Fine. The trend's your friend. Fine. I give up. I'm not going to argue with anybody. You argue with those people and they're nuts. They're like frickin' Democrats about the environment or whatever. I mean, they go crazy on you. Next thing you know, they're bombing your house or spraying paint on your fur coat or whatever. I mean, you cross those trend traders, they will do some serious to you. I mean, they will take you down. So I want to say right now, I don't want any problems with the trend traders. I learned my lesson. I am a counter trend trader by choice, and as soon as that R3 is touched, it has generally exceeded its average true range, its range for the day. It's done something extraordinary, and it is, in some cases, ready for a turnaround. I stack trades in that pink zone that you see right there. What I do when it hits R3 is I stack trades back down to that daily pivot with a buffer zone above the daily pivot. Does anybody have a question about that? And that concludes our presentation. No. That's it. I mean, that is it in a nutshell. If you make it far more complicated than that, you're only going to make it more difficult. That's essentially what I do. There's nothing else. There's no economic report that I reflect on. There's no religious documents that I refer to. There's no deities that I pray to before I do this. There's no additional people that I check in with. This is it. That's the setup. Once it hits R3, I stack trades equally distant apart back down towards that daily pivot with a buffer zone of 10. It's generally 20 pips in front of that daily pivot. In trading the Vortex, you can experiment with a stop loss of 50 to 75 pips above R3 or 50 to 75 pips below the S3. I have been doing an extraordinary amount of work on this. So I'm going to speak to you. For right now, you are the only person that is important in this room. I want everybody else to just ignore me because this is advanced. No, here's the deal. And I know you know what I'm talking about, so I don't need to be overly complex about this. At the 50 mark, if I put a line 50 pips away from my first trade entry and it closed above that mark, as if that were a line in the sand that I was going to draw, and the currency pair closed beyond that level, I would thin whatever trades had been opened up down to like no more than 3. So if it had opened up 7, I'd thin it down to 3, and I would just eat it. Because we have no hedging. Hedging is over because you know what? Hedging is bad for you. But smoking, that's okay. So at that 50 mark, I'm going to thin it out. I'm just going to say, screw this. I'm out. I'm done with this. This is over. And at 75, I dump the rest of it. It's gone. And then I'll restack the whole thing all over again. So from a stop-loss point of view, I'm going to stick with that. And to answer your question even more specifically, I'm going to stick with the rest of the whole thing all the way to the profit. Generally speaking, I'm going to stick with the whole rest of it all the way. I'm going to have this stop in place, and then the rest of it is to the wall. I'm going to go for it. I'm going to go for all 10 trades to open, or 9, whatever you can fit, and then close out at their profit target. And if not, I'm going to do this. I'm going to thin them out at 50, and I'm going to thin the rest out at 75, and then that's the end. And then and this has been working. This has been working quite well in the absence of hedging or other types of strategies. This has been working reasonably okay. And the problem is you take a hit every once in a while. And so it's disappointing that there's not some other way, but you take a hit every once in a while. In a moment, I'll talk a little bit more about when it kind of makes sense to take that 9/10 and blah, blah, blah. But as a stop loss point of view, this is what's been working. The stop doesn't exist, remember, until the trades start to open. Remember that as you look at the following charts. I realize that as you look at the following charts, you might think that it's stopped out, but in reality, it hasn't even started opening trades yet. So I'm going to give you an example of what I mean by that. In this instance right here, the currency pair has risen up to R3 and then fallen back down, and I can barely show you right here, and maybe opened one of my trades. I'm just using it as an example. This is not, I don't know if this setup right here really opened to the first trade in the stack. But let's say it opened to the first trade in the stack right up there in that pink zone. I had 10 trades spaced 5 pips apart for a 50 pip stack that had a profit target that was 20 pips above the daily pivot. So in this example right here, I would go 20 pips above that daily pivot and draw a line. That's my profit target. And then I would go 50 pips above that and I would draw a line. And that's where my stack would be in between the buffer zone and that 50 line. Let's say that in that pink zone it opened up trade number 1. Well, over there in that red mark, that's where it stops out. That's a 50 part. And I'm going to thin that out. If it was 7 trades open at that point, I would thin it down to 3. And then I would give the rest a chance to still complete, but I would thin them out to at least scale down my loss. Then it falls down later on and opens that rest of the stack, but doesn't turn around. I mean, that's the acceleration that we wanted originally that we didn't get. Yes, Mel? Yeah, I have all these weird terminologies. I have this crazy language that I speak. When I speak about thinning your trades out, I have a bunch of trades open, and now I'm going to start thinning out my exposure. I'm going to start taking some of those off the table. I'm going to start taking some of that off. So I'm thinning out or paring down or getting rid of some of the trades that are open. And once it hits that 50 mark, I'm going to start thinning it down to 3 trades or so. Other questions, comments, or jokes? Yes? Yeah, right. Exactly, exactly. And have you heard me talk about the fib stuff and some of the other stuff? Okay, so that's a conversation we need to have because some of what I'm doing there operates in much the same way. And what I wanted to say, if you've heard about any of those other methods of stacking that I use, that would also apply to those as well. So just say this is a universally applicable for me way of thinning stuff out. Close is close enough. In this example, horseshoes and hand grenades. It's odd, he's holding a toilet seat and his tongue is out. That's gross.